Thursday morning, May 14th, 2026. Pre-market. The bell hasn't rung yet, and if you look at the S&P 500 futures, we are basically flat in this agonizingly tight 5-point range.
Yeah, Nasdaq 100 is down, 12 pips? The implied open looks completely paralyzed on the surface.
Right, but when you look at the institutional memos hitting the desks overnight, it is, well, the tension is ridiculous. It's an absolute powder keg.
It's a massive game of chicken. The overnight session was basically defined by this tug of war. The desks are calling it the AI breakout versus the liquidity trap.
And that's exactly the mission for our deep dive today. We are decoding this paralysis. You've got this hyper-resilient AI-driven equity market going head-to-head with a macro backdrop that is, frankly, flashing bright red.
Yeah, and to figure out where the traps are hidden before they open, you have to look at the macro bedrock first. Because the market got a massive reality check yesterday.
You're talking about the PPI print.
Exactly. For a year, the street has been absolutely clinging to this soft landing, inflation is dead narrative, and yesterday's producer price index basically took a sledgehammer to it.
It landed 10 basis points hot at 0.3%.
Right, and the knock-on effect there is huge. It drove the year-over-year wholesale inflation up to 6%. We haven't seen wholesale running that hot since 2022.
But the real risk here is the spread, right? Because headline CPI is sitting at 3.8%. So you've got factory gate costs at 6%, which means suppliers are just eating that margin compression right now.
They're eating it for now, yeah.
Yeah.
But pass-through costs are inevitable. That 6% eventually hits the retailer, and then it hits the consumer. But, what's really panicking the desks is how the bond market is pricing this in.
The 10-year.
Right. The 10-year Treasury yield is just climbing relentlessly toward 4.5%. It's sitting right near an 11-month high.
And you pair that with the U.S. dollar index, DXY, extending that winning streak up to 98.50. That is a double-barrel headwind for valuations.
It crushes them, especially for multinationals converting foreign revenue back into a strong dollar. But the kicker here, the thing that really shifts the psychology today, is the confirmation of Kevin Warsh as the new Fed chair.
Yeah, known for being incredibly hawkish.
Exactly. So the desks are looking at a guy stepping in to essentially yank the parking brake on the economy. The new mandate isn't soft landing, it is higher forever.
Higher forever, which completely changes the risk premium. If the U.S. government guarantees you 4.5% risk-free, why are you chasing a 6% return on tech stocks at all-time highs?
You wouldn't. In any normal historical context, a 4.5% yield plus 6% wholesale inflation would just trigger an absolute free fall in equities.
But we aren't cratering. That's the wild part about this pre-market volume. We aren't in free fall.
No, because the market is wearing a bulletproof vest right now. It's entirely defying gravity because of the evolution in the AI trend.
Right, a second wave.
Right. It's not the gold rush anymore. We aren't just blindly buying compute power and GPUs. The massive institutional rotation right now is all about throughput. It's the infrastructure phase.
Which explains the massive pre-market gap on Cisco today. CSCO is up roughly 19% right now.
Yeah, they completely smashed their Q3 estimates and aggressively hiked the FY26 guidance. It is total validation for the physical build-out, laying the high-speed rail for these data centers.
Gap and go potential.
Exactly. And the levels are super clear on this one. The bull case needs to clear and hold 128 after the bell. If it holds, it's a multi-year breakout. But if it fades and rejects that 114 floor,
then the narrative flips back to legacy dead money, and you're looking at a massive downside gap fill.
Spot on.
Okay, so if Cisco is building the highways, Palantir is building the vaults, PLTR is up 4.5% this morning on that Tokyo news.
The $800 million sovereign AI contract.
Yeah, sovereign AI. Is wild that we are even using that term now as a baseline.
But it proves the moat is real, right? Defense tech isn't cyclical. Sovereign nations are locking down militarized AI as foundational national security. It's a secular tailwind that completely ignores whatever the 10-year yield is doing.
Yeah, but look the other side of that coin. Because while Tokyo is spending nearly $1 billion on defense AI, the U.S. consumer is actively cracking. Just look at the pre-market gappers. Disney is down 5.1%.
Right. Streaming churn just hit a 2-year high.
And streaming is the ultimate canary in the coal mine for discretionary spend. When that 6% wholesale inflation finally hits a grocery store, the first thing a consumer does is click cancel on a $15 monthly subscription.
Exactly. So institutional money looks at the Disney churn, they look at the 4.5% yield, and they panic about the consumer. So they rotate out of discretionary and hide their capital in the AI infrastructure bunker.
Which brings us to the actual catalysts moving the tape today because these mega cap AI plays don't exist in a vacuum. We've got the Trump-Xi summit ongoing in Beijing.
And to be totally clear on this, the trading desks are entirely agnostic to the politics here. We're looking at this strictly through the lens of supply chain velocity and corporate valuation. Zero ideology.
Purely mechanical.
Right.
But the scale is insane. NVDA is sitting at a $5.5 trillion market cap. Jensen Huang is physically at the summit.
Because the U.S. cleared those H200 sales to Alibaba and Tencent, but Beijing is weaponizing the delivery logistics. They are playing hardball on the actual physical shipments.
So binary outcome for NVDA today.
Extremely binary. If we get a headline out of the summit that clears the delivery with no tariffs, the memos are projecting a massive blow-off top. We're talking a rip to $245 into total blue sky territory.
But if the talks break down...
If they break down, the valuation is so stretched that the sell the news reaction will be brutal. You're looking at a structural flush down to $212. It's a massive swing hinging on one headline.
Same dynamic with Tesla. I mean, TSLA is up 14% this week. Elon Musk is at the summit, too. They just got FSD regulatory approvals in Belgium. And the Gen 4 Cybercell ramp is apparently 6 months ahead of schedule.
The short squeeze there has been violent. Bull target is 480 today if it clears 450 in the opening hour. But if the summit premium fades, bear target is a hard reversal to 415.
But wait, at a $5.5 trillion valuation, with CEOs literally sitting at bilateral summits negotiating with heads of state, are we even trading tech stocks anymore? Or are these just sovereign geopolitical assets?
The desks are officially treating them as sovereign assets. I mean, we aren't analyzing auto gross margins today. We're trading global power plays. The micro is so electric, it is entirely drowning out that terrifying macro picture.
The AI greed is blinding the market.
It is, which leads us right into the crossfire. The liquidity trap.
The pain trade.
Yeah, the retail pain trade. Because retail is piling into the Nasdaq at the absolute highs, thinking AI is just permanently decoupled from debt mechanics, they are completely ignoring the 24 basis point jump in the 10-year yield this month.
Because of the momentum divergence.
Exactly. The surface level looks amazing, all-time highs on the index. But if you look under the hood at the advanced decline line, the AD line, it is shrinking fast.
Meaning the generals are charging ahead, but the actual army of individual stocks has already retreated.
Right. It's a total illusion of strength. A tiny handful of massive AI names are dragging the weighted indices up while the rest of the market is stalling. And that creates a highly engineered trap for the retail guys buying the rip.
So let's establish the lines in the sand for the day. Give me the actual levels. For the S&P 500 futures, the pivot is 7,466.
Right, with the all-time high resistance sitting right above it at 7,483. So if we stay above 7,466, the strategy is neutral to bullish.
Assuming the data holds up.
Yeah, if the data is good and we clear 7,483 on real volume, bulls can run it to 7,515. But, and here's the trap, if it pushes into that 7,480 range right near the open, finds zero buyers, rejects, and falls back under the 7,466 pivot.
The trap springs.
The trap springs shut. All those late retail buyers who bought the open get instantly squeezed. They panic sell, and because the AD line is so weak underneath, it's just an elevator shaft. It flushes straight down to the 7,407 volume gap.
Wow. And the setup on the Nasdaq 100 futures is arguably even worse. I mean, the RSI is screaming over 88 right now, which is just stretched to the absolute historical limit. The momentum is pure fumes.
Yeah, NQ pivot is 29,480, and the institutional desks are actively stalking a stop-run fake-out here.
Because the all-time high is 29,565.
Right. So the big players need massive liquidity to offload their bag, so they push the tape just a hair above 29,565 to trigger everyone's breakout buy orders.
Retail floods in?
Retail floods in, the institutions dump their shares into that exact wave of buying, and then the price violently reverses back under the 29,480 pivot.
Confirming total semiconductor exhaustion.
Exactly. And if 29,480 breaks, the mean reversion target is a catastrophic drop to 28,660.
So the trigger for all of this technical damage is the 8:30 a.m. Eastern data.
The retail sales and jobless claims. Because if retail sales miss, the narrative flips in milliseconds from strong growth to stagflation.
And if the 10-year yield crosses 4.5%.
The AI bulletproof vest comes off. Institutions will just ruthlessly dump the crowded tech trades to lock in profits, rotate into cash, and leave retail holding the bag at the absolute top.
Which means the mandate today is strict discipline. We are sitting at this insane intersection. You've got sticky 6% wholesale inflation and a hawkish Fed going to war with this massive AI infrastructure boom. We've got tech CEOs negotiating geopolitics in Beijing, and underneath it all, a massive momentum divergence between retail euphoria and institutional caution.
You cannot blindly chase the open today, period. You have to let that 8:30 a.m. data hit the tape, let the dust settle, respect the 7,466 pivot on the S&P and the 29,480 pivot on the Nasdaq.
Because if those levels fail, the geopolitical hype vanishes and we get a liquidation break.
Extremely fast.
So stay liquid. Know your exits before you put on the trade. And as you sit at your terminals waiting for the bell today, keep this provocative thought in mind. We know the sheer momentum of AI is currently acting as a bulletproof vest against the highest borrowing costs we've seen in years. But if inflation stays sticky and the Disney data is right and the consumer finally breaks, what happens to the entire foundation of the market if that single AI-woven vest starts to fray?